Hello everyone and welcome to TTT Markets. I'm Fotis Papafiofanous, I'm a professional portfolio manager, and in this video I'm going to discuss with you risk management for beginners. It is important that you stay and watch this video because we are going to share with you practical, proven steps to protect your capital and start trading with confidence and profitably. So what is the number one advice? What is the one thing that you have probably seen everywhere online? The number one advice. It might look something like this. This is a risk reward or reward. This is a risk reward or reward risk cheat sheet. What does it mean? What does it say? It says that depending on the frequency of your wins, what is your success rate? Your risk should be proportional to your reward. So for example, if you wish to make money with a 20% win rate, then the reward must be 5 times your risk. So if you risk $100, or 100 pounds or 100 euros, you must earn 500. If you make $400 or pounds, you get the idea. For every $100 you risk, you barely break even. Anything less than 4 to 1 and you are at a loss. You can see that if your win rate increases and you have the appropriate risk-reward ratio, then also with a smaller risk-reward ratio, you can still be profitable. For example, what if you have a 30% success rate? With a 30% success rate, you need a 3 to 1. Your reward needs to be 3 times your risk in order to start making money. If you have an edge, if you are good at this, and your success rate is more than 40%, then you lose money. If you trade on a one-to-one basis, that means you risk 100, you make 100. Then you will not be making money. Over the long run, you will be at a loss. But even with a 2 to 1, you are profitable. And of course, if you have a 50%, a 60%, if you have a 50% with a 1 to 1, you break even. If you have a 60% success rate, then even with a 1 to 1, you are profitable. So this is, I think, the most common advice, the most popular advice that you will hear online. Pay attention to your reward risk, and depending on your success rate, on how frequently you win, then you should have a proportion between the risk and your reward. But this is not happening, is it? It's not so easy. Then why do so many traders lose money? If it is that simple, if you only have to pay attention at the reward risk ratio, why do so many traders lose money? Because, and this is where it gets interesting, it's not only this. And then there are other things. Do you really know what is your success rate? If you are starting now, what is your success rate? You have no idea. Secondly, what is your edge? What exactly is your edge? It says here, oh, if you win 20%, 30%, 40%. But what implies that you have been trading for a while, you have a large sample of trades, and more than 100, definitely not less than 100, you are trading for at least 12 months, in my opinion, so you can look at the results and you can say, right, I am a 30% trader, a 40% trader. Do you recognize the edge? If you begin to trade and you think, I am disciplined, I'm going to go for a 3 to 1, I'm going to make money, I'm very disciplined, I'm going to honor my stop losses, and that's another thing we can discuss. But let's say even if you do that, what is your edge? You have no idea what your edge, what is your alpha. Does your system has an edge? Do you know that over 100 trades or over 50 trades, you will be making $2 on average? You don't know. This is why you should start paying attention right now, and I'm going also to give you another dimension. So number one, and I'm going to open a chart. So this is just a daily Euro USD chart. This is, as I said, daily time frame, and I have placed some trend lines. That's it. I have zoomed out, I have seen the big picture, I have drawn some very important trend lines on the weekly time frame, I have highlighted the trend, and I do this so I know where am I doing business. And then, let's not talk about tactics right now, let's discuss risk. Step number one, understand your risk exposure. Do you know if you lose, how much you are going to lose? So this is step number one, understand your risk. What is your leverage risk? What is your psychological risk? You might say, what the heck is this? I will tell you. Let's say you do everything by the book. You say, I'm going to sell here, I'm going to place a stop above, my target is a little bit lower. I'm just sharing an example right now. I'm not suggesting that you should go ahead and do this. And this is my stop. Actually, let me use this. This is a nice tool offered by TradingView. Sorry, not this. I think it's this one. Yes. So let's say this is my entry. This is my stop. And I will go for a 2-to-1. So let's start with this. So this is my profit target. I'm going for a 2-to-1. Okay, beautiful. And you say, this is my stop. I'm going to risk 100 to make potentially 200. Do you think that's your risk? This is not your risk. Some traders are not aware of the leverage risk. Compared to your account, you are risking $100. You say that's nothing. Yes, but what is the size of your account? It is nothing if you have a $5,000 account. But what if you have a $500 account? What happens if you have a $200 account? Then 100 becomes an issue. That's 50% of your total money. So this is leverage risk. So you need to pay attention. What is the leverage? How much of your money you are risking? The most important thing that it is something that it is not being discussed so much is what is your psychological risk? Can you afford to lose $100? Or every time euro approaches this area, you start shaking and you are scared and you get stressed and you are getting worried, and all you wish to do is just get out of this trade. You wish to get out. You can't stand it anymore. You can't be in this position. You feel stressed, you feel bad, and you don't have the tolerance to watch price action. You can't do this. So the euro goes up, it goes in this area, it approaches the stop loss, and you freak out. So that's the psychological risk. Is this something that you can afford? So do you see how many different kinds of risk we have discussed here? Number one, market risk, leverage risk, and psychological risk. So it is important, and I am emphasizing this, to understand your personal risk tolerance based on your financial situation and your experience. This is very important. So this is your first defense against impulsive decisions. Because would you like to bet something? If you are new and the price approaches your stop loss, would you like to bet that it is very likely you are going to close the trade before it gets to stop loss because you can't stand the pressure? This is something that happens. I have done it before. Sometimes I do it now. It's human. So don't think that this is something that only rookies are doing. It happens also in the professional space. So the number one line of defense to avoid such a situation, to avoid an impulsive decision, is to be aware of your financial situation and your experience. And what you keep from this is this: market risk, leverage risk, and psychological risk. Then we move to the next step. What is the next step? So number one, we discussed you need to be aware of who you are, what is your risk. Number two, always use stop losses no matter what. Be careful here, because sometimes the brokers are after your stops. So if you are trading a volatile pair that is usual to have 100 pip range during the day, and you have a stop loss of 20 pips, well, guess what? It is extremely likely that it can get hit. So I'm not going to discuss now how to place stop losses, but it is important to use a stop loss. That stop loss is a non-negotiable rule. You don't have actually need to place it, but you need to keep it in your head that that's my stop right there. If you don't wish your broker to see your risk, that's fine. But if you are in front of the screen all the time, you must make a non-negotiable rule, a mental rule, but if the price goes here, I'm out, no matter what. Again, if you are not aware of who you are and your risk, it might go here and you decide to give it a little bit room, and then a little bit more room, and so on. So no, a stop loss is not negotiable. So you know, but how are you going to have the appropriate stop? How will you know how much you are supposed to risk? So then you are not affected psychologically, you are calm, you trade with confidence, and you can do all those nice things. How can you do it? The third step is smart position sizing. So what are you doing? Let me give you an example. You go to a calculator like this. So this is my FX book. It has a calculator. The symbol is Euro USD. The currency of the account is USD. What is your trading size? Okay, let's discuss. How much are you going to risk? Let's say I decide to sell at 1890. I'm going to place my stop at 1920. Again, this is a random example. I wish to sell. Oops, sorry, I didn't put the size. One lot. Calculate. So I'm going to risk 300 bucks with one lot. So you ask yourself, if I risk one lot, I'm going to risk 300 bucks. Is this something you can afford to lose? How big is your account? If it is 10,000, you can go ahead and do it. If it is 1,000, that's 30% of your account. You don't wish to do it. So my advice to you, and this is what I'm doing in my day-to-day trading, I'm managing millions, and still I am using this approach. I have very small size. I'm nimble. I am not going for the home run. This is something that I avoid. No home runs. So decide in advance how much you are going to risk. So for example, what about 0.5? Okay, that's 150. So you see, if you want, you can choose units. So you can say 5,000 units. That's $15. 50,000 units. So depending on what kind of lot sizes the broker is using, is it units or is it lots, you can manage accordingly. And so you need to see how much you are risking. You can also do this, 0.1. If you do 0.1 lot, that's 30 bucks. So this is what you should be doing. So step number 3, smart position sizing. I'm going back to the chart and you say, okay, depending on my account size, this is my stop, this is my entry, this is my target. I am going for it at 1, but I'm going to risk 0.1 because I have a $500 account. What I do, and I'm coming back to this, they say, oh, don't risk more than 1% of your account. I'm saying, if you are uncertain about your edge, if you cannot pinpoint exactly your edge, do even less. Risk 0.3 or 0.5% of your account. At least start with small position sizing and then go ahead and increase it. Do not start straight away with a large percentage of your account. So start with 0.3, 0.5% of your account and then go to 0.7 or 1%. Definitely do not risk 2%. Very easily you can have 5 losses in a row and that's it. You are down 10%. Fourth step, so let's recap. Number 1, self-awareness. Step number 2, always use a stop. Number 3, practice smart position sizing. Number 4, Plan your trades in advance. Do not stare at the chart and randomly decide, oh, that looks good, I'm going to buy or I'm going to sell. That's a randomness. This is price action fooling you. Plan in advance where you are going to do business. So in this way, you avoid having weird emotions. You avoid having impulses. What I have done in my case, for example, I do this, I zoom out. I look at the big picture first. Would you like to buy euro there at close to 119? No, there is no way I'm going to buy euro up there because I have the long-term trend line. I'm more inclined to sell with a caution. I'm not betting the farm, but I'm more inclined to look for a short position. Why? Because it's the long-term trend line and there are other fundamental reasons. So this is my outlook. My point is I plan the trade ahead. Where am I going to do business? If euro moves down here, I will not be looking to sell, I will be looking to buy. So I know in advance what is the structure of the market. Is it trending? Is it moving up? Is it moving down? And I know where I'm doing business and what I'm going to do. So I plan the trades. I do not randomly look at the chart and then decide what to do. If you do this, you are keeping emotions in check. You acknowledge the fear and greed that you have as a human being. In this way, you know the areas that you are going to do business. So if the euro stays here and it's moving up and down, you are not going to have impulsive emotions. Sell, buy quickly, I'm going to miss out. No, this is not going to happen. Why? Because you have planned the trade in advance. What you should be keeping from this video. Number one, have self-awareness. If you are a stressful person, if you are getting stressed easily, if you are worried, if you don't know your edge, or if you are at the other side, if you like to take risk, if you are not afraid, if you are willing to bet big, be aware of it and be aware of how much you risk. Be aware of your leverage risk and be aware of your psychological risk. Always use a stop loss, but know exactly if something goes wrong, how much you are going to lose. And make sure that the amount you are going to lose is not something very big compared to your account size. Because if I go back to the cheat sheet, 1 second please, do you know how difficult it is to recover? Let me ask you this, how much do you think you need to make if you are down 50%? Let's say you lose 50% of your account. How much do you need to make to break even? You need to make almost 100% just to break even. Now, if you have already lost 50%, how likely is it that you are going to make 100% in profits? This is why keep your losses under control, bet small, especially at the beginning, use stop losses less than 1%, 0.5, 0.3, and so on. Keep this in mind, the reward risk, but at the beginning, this is not going to help you because you don't know your win rate and it is very likely to make mistakes. Price action is changing. You are not going to stay in the trade, so you go for a 3-to-1, a 4-to-1, 2-to-1, whatever it is that you are after. This is why I'm giving you this advice and I'm saying, and let me go back to the chart. At the beginning, bet small and go for a 1-to-1. Yes, you heard me correct, 1-to-1. Don't try to go for 3-to-1 or 1-to-1. Try to have a 1-to-1 reward risk, but something like this. Try to do it as many times as possible, and after you feel comfortable and you can see your win rate and it is more than 50%, it is closer to 60, 70%, and you have a large sample of trades, then you can go ahead and try to go for a bigger reward, a 2-to-1, or why not 1.5-to-1, something for example like this, 1.5-to-1. Oops, sorry, I moved this accidentally. Let me keep it there and That's what I wanted to move. So you are going for 1.5 to 1, something like this. So my point is, don't be in a hurry, go for small, bet small, 1 to 1 at the beginning, bet less than 1%. Be aware of the risks, not only the stop loss. Having a stop loss is not your risk. There is also the leverage risk, the psychological risk. I would say the psychological risk is the most important and extremely important. Plan your trade in advance. Understand the structure, where you are trading from, and know in advance what you are going to do so you avoid having impulsive feelings. Thank you for watching. I hope this video is going to help you be confident, manage your risk better, and increase your profitability.